Hello, everybody, and welcome to ISTAT's Learning Lab again. Today, we're going to talk about the lease market in a hurricane. And to do that, we have Ethna Manning, who is Head of Funding, Investor Relations, and Tax at SMBC Aviation Capital. I'm joining you on the phone today because my internet is being funny. So that's why you can only see a picture, I think, on the screen. So Ethna joined SMBC in 2005, and she's responsible for third-party funding and investor relations. And she's also responsible for tax within SMBC, and she's acting head of finance. And during her time with SMBC, Ethna has also covered aircraft trading and third-party financiers relationships in a number of markets for the business. Prior to joining SMBC, Ethna held a variety of roles in structured finance and corporate banking. She has a Bachelor of Commerce with honors and a Master's in Accounting also with honors, both from University College of Dublin. And she's a Fellow of the Institute of Chartered Accountants in Ireland and the Irish Tax Institute. Before I hand over to Ethna, I just wanted to say that during the session, you can use a Q&A button at the bottom and write in questions for Ethna that I will try to go over after her presentation. Now, I would ask you to just keep the questions general and not ask specific questions about SMBC Aviation, nor of any specific airline. So I would appreciate if you could do that. And then I also want to mention that the next time we have a Learning Lab is on February 9th, and that's going to be the airline and leasing market in China with Li Lu. And that session is going to be an hour earlier than today because Li is based in Hong Kong, so the time zone is such that it's better to have it an hour earlier. And we're also planning some more Learning Lab events. I think there's one coming up on the 2nd of March. You can check in with ISTAT's website, istat.org, in a week or so and get more detail. So with that, I would like to hand over to Ethna Manning from SMBC Aviation Capital.
Thank you, Niels, and thank you for that kind introduction. Good morning, good afternoon, good evening, everybody. I'm delighted to be here today to take some time to look at what the impact of COVID on the leasing sector, both on the asset and the liability side. So before I start, just going to share my screen. And maybe can somebody, Niels, can you confirm that you can see that?
Yep, we can see that.
Yep, great. Okay, so just before I start, I just wanted to give a brief introduction on SMBC Aviation Capital. So we're a top 5 aircraft lessor. We have a fleet of over 600 aircraft owned, managed and committed. Now 2021 will actually mark the 20th anniversary of our business and the 9th anniversary of the acquisition of the business by our current shareholders, SMBC Group and Sumitomo Corporation. Now our shareholders have a long history in the sector and they provide very significant financial support to us, currently standing a little over $11 billion, and that's about $3 billion in equity and $8 billion in unsecured debt facilities. So our credit ratings from S&P and Fitch are both A-. And over our 20-year history, we've always been very focused on owning young liquid assets. So today our portfolio is over 80% narrow body and it has an average age of just 4.2 years. In addition, over the last year, we've been very active in the sale-leaseback market, and I'll talk a lot about that in due course. But from our own perspective, we concluded about $2.5 billion of new transactions over the last 12 months. So then getting into the presentation, and just so today, what I want to do is I've split it up into 2 halves. First half, we're going to look at just looking at the impact of the pandemic on the lessors business. And I know a lot has been written about that, but I just think it's interesting to look at kind of where we've come from and hopefully look at where we may be going to. And then spend the second half of the presentation looking at lessors' access to funding, how that's changed, and really looking at kind of how lessors are quite different in terms of how well they're capitalized today than they were, say, going into the global financial crisis. And that's really been kind of a game changer, I would say, in terms of how they've dealt, how we have dealt with the current challenges that we face. So then, just looking at what the landscape looks like today. Today, with the leasing sector, from a standing start, as you can see on the chart there, back in 1970, we have 43% market share. We own over 11,000 aircraft of the world fleet, and that's valued at about somewhere over $300 billion. I suppose it depends when you take that valuation. But over 50% of new deliveries are currently been financed by leasing companies. So even with OEM production cuts and retirals, you're still going to see pretty significant net growth there in the coming years. And many of you perhaps on this call are very familiar with what has driven that growth. But for those that aren't, really, the growth in aircraft leasing is probably down to three factors, I would say. It's firstly, it gives very valuable fleet flexibility to airlines. It also reduces airline capex. Because clearly, we own the asset, and they don't have equity in it. And then finally, it removes residual value risk onto a lessor who perhaps is better equipped to manage that. And I think, if you look at the liquidity pressures that are facing airlines today, reducing capex is a real key near-term focus. But longer term, I think they're going to increasingly value that fleet flexibility that it offers. So I think you're going to see significant increase in demand for leasing as we go forward. Now, if we look at what the lessor landscape looks like today in terms of the larger leasing companies, we've shown here the top 24 leasing companies in terms of relative size and portfolio age. And just a couple of things to note, I think, here over the last 10 years, you've seen quite a significant capital inflow from Asia. And in the chart here, 13 of the top 24 leasing companies have Asian shareholders. They own about 3,000 assets. That's about 25% of the leased fleet. Those lessors tend to be more focused on younger aircraft, and that's usually a function of their competitive cost of capital. Now, another interesting feature of the last cycle really has been the growth in the midlife lessor business model. And two of the largest midlife specialists are Castlelake and Carlisle Aviation. And between them, they own over 400 aircraft. And the growth in the midlife leasing model, I would say, is a welcome development for both the leasing sector as a whole, but also for airlines, because the midlife lessor has provided a really important distribution channel for lessors who are focused on newer assets. And the lower cost of capital that perhaps those lessors have means that an airline is getting a more competitive cost of, or more competitive lease rate on new assets. But the lesser specialization, if you will, means that there's more predictable kind of risk-adjusted returns in both business models. And then the other point I just wanted to make in relation to kind of what the themes in the last 10 years was the significant M&A activity. And over that period, you've seen of the top 24 lessors, 12 have either changed ownership or acquired competitors. So you might think that with all of that activity that we would have had significant consolidation, but again, perhaps as some of you may know, that's not the case. And today the market is more fragmented than it was 10 years ago, when the top 10 accounted for 50% of the total market, or sorry, 70% of the total market. And today that's just 50%. And that's a function of really the growth in the overall sector and the capital that has come into it. But the influx of that capital, together with, I would say, the liquidity in other aviation financing products, has led to a very competitive and had led to a very competitive environment pre-COVID, with the corresponding downward pressure on lease yields. Now, looking at that top of the market and what it looked like, from a lessor's perspective, well, 2019 was a year of record profitability for leasing companies, at least in absolute terms. And the sector had seen significant capital inflows, as I've discussed on the previous slide, and demand for leasing was growing. But really that influx of capital, together with, as I said, the liquidity in other markets, was having an impact on lease rates. On the direct order side, we were seeing signs of oversupply, particularly on the wide body side, and that was making placement challenging. And again, I suppose, downward pressure on lease rates. Now, a real positive was the secondary aircraft trading market. And we had seen over the course of the cycle really significant growth in the aircraft investor base. And this was really positive because it really improved asset liquidity, and it allowed lessors to manage portfolio metrics, airline concentrations, and other portfolio metrics. And as we have seen, some of the larger leasing companies are more focused on newer assets today, and oftentimes it kind of goes hand in hand with the assets you invest in. If you own younger assets, you need a competitive cost of capital. But if you're willing to, if you have the specialism in owning older assets, then it's a different business model. But in terms of funding, the investment grade leasing companies were either funding themselves primarily in the bond markets, and clearly if you were FI owned, you perhaps had some access to shareholder funding. But we'd seen very significant bond issuance in the previous number of years, and pre-crisis that was probably, total issuance was probably somewhere in the low 60s. And in relation, the broader bond market was very hot, and we've seen that endless liquidity in the bond market in the last number of years, and that combined with the growing depth of investor buying lessor bonds really compressed spreads in the latter years of the cycle, and we'll see that a little bit further in the presentation. And then that liquidity was really replicated in other funding markets. And so there was lots of bank funding and ABS funding across the piece, and really that was then driving very significant trading activity that I spoke about. So what happened when COVID hit the wider world and the industry? Well, clearly much has been written about the unprecedented impact of the pandemic on the aviation sector. And, I think the severity of the current crisis has led many commentators to wonder if the future of air travel has fundamentally changed. And I think, look, the magnitude of this recession means that it will have a deeper and longer lasting impact. But ultimately, demand for air travel has a very long and proven relationship with GDP growth. And, while the crisis may alter the shape of demand somewhat, and accordingly, you may see some airlines need to look at their business models, I think the correlation between economic growth and growth in air travel will continue to hold true. So in terms of the financial challenges that firstly the lessors faced, well, with the increased level of airline payment defaults, clearly that put pressure on lessors' working capital. And then in relation to their financials, we've seen increased levels of provisions for credit losses and increased levels of impairment. And that's particularly for maybe less liquid assets, and I'll touch on that maybe a little bit later. On the airline side, airlines have received close on $200 billion of government support since the start of the crisis, and I think IATA are now calling for a further, I think it's up to $70 billion of support through the first 6 months of this year. But the provision of that support has been, I would say, uneven across regions and airlines, and we've had some casualties. And there may be some more, but for those that survive, and we will have an industry when all of this is over, there's going to be real opportunities for the survivors, but there may be some amendments to profit models that airlines are going to have to think about, perhaps in a changed market demand environment post-COVID. But looking at that path to recovery, clearly, the approval and development of multiple vaccines has been a really positive development for the world as a whole, but clearly for this industry. But we're seeing the complexity in trying to get those vaccines, delivered, produced and rolled out. And, it looks like at best, really, we're going to be looking at the second half of this year before a meaningful level of vaccination will be achieved. And we have to remember, it is only one of the tools on the path to recovery. The key will be the lifting of government restrictions on travel and really a more coordinated approach to travel protocols. But again, this is more likely to happen when a meaningful level of vaccination is achieved. And, in terms of travel protocols, there's a lot of discussion around vaccine passports and certification. But again, it's a simple concept, and there are many concepts out there, different versions of that concept out there, but really it's probably quite complex to implement, and it's going to take time. And so, it's going to be a challenging first half, I think, for airlines. But when the recovery does come, I think it will come quicker than people expect. There is huge pent-up demand for travel. I don't know about you, but I cannot wait to fly somewhere that's not Dublin, and hopefully not, it's not Ireland, as much as we love this country. But I think, like, looking to kind of data, we have seen that where governments have relaxed restrictions over the course of in different jurisdictions over the course of the last year, we have seen an immediate and very significant impact on forward booking. So I think that's really positive. And the recovery was being and will be led by regional short-haul traffic. And we had already seen that at the beginnings of that in China and parts of Asia, and then to a more limited degree probably in the beginnings of it, perhaps in Europe last summer, and to maybe perhaps in the US. But when it does come, clearly you're going to see low-cost carriers seeking to capture market share. And you're likely to see an increased level of low-cost carrier startup. And all of those developments will really favour young, fuel-efficient narrow-body aircraft over older and larger aircraft. And then looking at perhaps financial strength and the financial strength of leasing companies, well, this is clearly a market where financial strength, and ideally being FI owned, was a key differentiator. Because it allowed you to withstand the pressures of that challenged operating environment, but also give you access to competitive funding to capitalise on the opportunities that it presented. And in terms of those market opportunities, we've seen obviously a lot of, I think, over 15 billion of sale-leasebacks done in the past year. But I think as airlines seek to replace some of that government support, and remove direct government influence on their airline, you're going to see increasing leasing opportunities as airlines seek to monetize assets. And if we look back kind of over the last 12 months and the sale-leasebacks that were done, you did see kind of coming just as the crisis hit, a lot of the newer entrants would have taken a step back, and some of the larger lessors also stepped back in kind of focused on shoring up liquidity to meet near-term commitments. That said, clearly with the reopening of the corporate bond markets, we are seeing an increasing pool of lessors looking and competing in the sale-leaseback space. So, again, depending on how long the recovery takes and how prolonged that is, you could see that wax and wane a little over the coming year. And then finally, kind of looking at just in terms of kind of the impact and how we might come out of this, the reality is, and again, I'll talk about this in more detail, but there's been a very sharp reduction in capital available from other aircraft financing products, and that together with the kind of contraction in capacity in the leasing market, has supported leasing returns over the last year. And, there's a lot of talk about the commoditization of the leasing product. And, I think a certain amount of that is the case, and that's somewhat behind, the increase in size in leasing companies, and kind of an effort to benefit from economies of scale. But I think that commoditization is somewhat disrupted by COVID. And, I think the fact that, perhaps, I would say very few investment committees or credit committees would have taken such an extreme downside scenario into account when they're kind of looking at how they, price risk. And that's going to have to be taken into account at some level going forward. So I think that will impact airlines' ability to access financing. And we're already seeing it, but I think it will persist, where lessors and financiers are likely to be more selective. And so for mid-tier and lower rated airlines, they're going to find it more challenging to finance their aircraft, and you're probably going to find, risk premiums are going to have to reflect that. So then just going back slightly more micro again for a moment and looking at some of the specific challenges that lessors have faced on their existing portfolio. So the majority of airlines asked for some form of deferral, since the beginning of the crisis. But what we saw was that as airlines raised liquidity, either independently or through government support, we did see a significant reduction in the level of deferral requests in Q3 and Q4 of last year. And I think what's very encouraging is, if I look at the collection rate on deferred rent has been really strong. Now, the current resurgence of the virus across most markets clearly is going to prolong the recovery, and it will put additional pressure on airlines' cash flows. And funding, the rent deferrals has put pressure on lessors' working capital. It has increased. There's a cost to that. As I'll talk about, lessors came into this crisis pretty well capitalized and in a strong liquidity position. But that said, funding rent deferrals has a cost, and it does hit bottom line, with profitability. And then just in terms of restructurings, clearly the level of government support that has been provided to airlines has mitigated the level of bankruptcies that we have seen. But there have been casualties, and others have sought protection, bankruptcy protection. And so while there will be pain, I think that the airlines emerging from protection will emerge leaner and smaller. They will probably have rejected some of their older, more non-core assets in favor of their younger and newer technology, and we're already seeing evidence of that. And so, we've talked a lot about the significant new business opportunities that have come from the crisis that we find ourselves in. But clearly, some of the challenges are also having a significant impact on profitability, and we've seen that in terms of lessors who publish their financial information. We've seen increased levels of asset impairments and provision for credit losses. And just maybe 2 points just to note on impairment here, and maybe this is because we're an IFRS reporter, but under US GAAP, there is a difference between US GAAP and IFRS in terms of how they recognize impairment. So under IFRS, you discount the probable future cash flows, and then you compare those to the carrying value of your asset. Now, under US GAAP, you take the same cash flows, but you don't discount them, okay? And so clearly, your cash flows are going to be greater, and therefore it's going to take longer to hit a point where those cash flows might be regarded as being less than the carrying value of your asset. Now, when you hit that point, then the US GAAP does actually apply a discount rate, but clearly that happens much later. And when it does happen, then the amount clearly is likely to be kind of taken all at once as opposed to gradual over time. And then secondly, just in relation to impairments, I think it's important to differentiate between impairments that arise from restructuring and impairments arising from perhaps a particular asset type that is permanently impaired. So in the former, if the market recovers, there may be potential to recover some of that impairment taken in the downturn, but in the latter, it's pretty unlikely. So again, if you own the right asset, the long-term impact on your financials may be lower. So then looking at, we all know that this industry is a capital intensive industry. So just looking at perhaps lessors' commitments, and just to give some context, in terms of lessors' order books, we all know that orders are placed a number of years in advance. But clearly, when it comes to the delivery date, nobody wants to force an airline to take delivery of an aircraft that they cannot put into service and potentially are unable to pay for. And here's where the manufacturers, the lessors and the airlines are broadly aligned, because the manufacturers won't want whitetails, and that's what we call an aircraft that doesn't have an airline home, because oversupply clearly will hurt the value of the asset and ultimately the price at which the manufacturer can sell new equipment for. So the effective duopoly that is Boeing and Airbus clearly is a key risk mitigant. And while they have profits, profit targets and sales targets, they tend to broadly act rationally. And if you look at this chart, you see that as air passenger growth increased, as growth increased in the years coming up to the end of the cycle, both Airbus and Boeing increased production in line with that long-term trend. And then when the crisis hit, you can see in 2020 the level and the number of deliveries significantly reduced. Now, clearly, that graph is very much helped by the fact that the MAX was grounded for the large part of last year, but it does give you some sense as to how the OEMs worked with both the airlines and the leasing companies. And just moving on, yeah, that was critical, I would say, in terms of lessors and airlines, but from a lessor's perspective, the ability to materially reduce your near-term capex commitments, and lessors did that by, in some cases, cancelling orders, and in other cases, deferring orders significantly to the right. And if you look, we just looked at a number of leasing companies where we have publicly available information as an indication as to kind of what was happening more broadly. But you see that they took, of the 7 leasing companies we looked at here, they took very proactive steps in the early months of 2020 and to reduce capex in 20 and 21 by over $18 billion, or 40% of the original committed amount. And for ourselves, we reduced our capex over that period by just under $4 billion, or 65% of the pre-COVID commitments. So it was a really important way in which lessors conserved liquidity to meet refinancing commitments or other commitments, and then for lessors who could, like ourselves, it also allowed us to use the access to funding that we did have through shareholder or otherwise to pivot into the sale-leaseback market where there were attractive opportunities. So looking at that sale-leaseback market, we've since March, I think I'm sure it may be slightly higher now, but on the last count that I looked at, there was over $15 billion of sale-leaseback transactions that have been done since last March. But I think what's interesting here is really the quality of those transactions. So you've really seen really strong airlines who maybe traditionally wouldn't access this market, tap this market to kind of monetize their unencumbered assets and to fund new deliveries, ultimately shoring up liquidity. And we've seen, for one might say obvious reasons, a discernible difference in the economic returns that is available in this market versus the direct order channel. And you would expect that given that it's going to take some time for traffic demand to recover, you would expect that dynamic to persist in the medium term. And as I mentioned, we did $2.5 billion in the last 12 months, and that was equivalent to 21% of our pre-COVID portfolio. And really, we see it as giving us the opportunity to really anchor our portfolio with these really strong airline credits. And these transactions, they will deliver significant ongoing return for the business, and then in due course, attractive feedstock in terms of aircraft for sale in due course as we kind of portfolio manage further down the road. But I think, if you look into 2021, you're going to see a higher level of deliveries. Airbus is talking about increasing production from Q4, I think, and clearly with the return to service of the MAX, there's about 450 part completed aircraft that are due to deliver over the next 2 years. And then just finally looking at supply, we just looked at the level of deliveries that we expect over the next 3 years of the assets that, well, we at least, and I think a lot of leasing companies look at the type of assets that a lot of people look at, or lessors look at. And what you see is we estimate that there's about $200 billion of aircraft, of A320s, MAXs, 787s, or A350s due to deliver over the next three years, and a lot of those deliveries are narrow-body aircraft. And now, for all the reasons that I've kind of spoken about, we would expect a lot of those aircraft to be financed in the sale-leaseback market. So before I finish this section, clearly it's fine to look at supply, but what about demand? So just wanted to just touch on the fundamentals of long-term demand for air travel. And you know, if we look historically, air travel has been growing at about 5% per annum. And growth in air travel, as I mentioned, is fundamentally linked to growth in GDP. And the drivers of growth in air travel has been and will continue to be the increased urbanization of the global population and the growing middle class, in particular in the highly populated emerging market economies. And as people get wealthier, their propensity to travel increases. And the potential for growth is quite compelling if you look at demographics in countries such as India, China, Southeast Asia, and parts of Latin America. And all of that growth has been facilitated by the increased and the proliferation, if you like, of low-cost carriers over the last 20 years. And I think, you know, from my perspective at least, I think, you know, there'll be many factors that will shape the future growth of air travel. And, you know, it may not in the near term continue to grow at 5%, but you know, it probably will get back there. And you know, the future shape of that of demand is yet to be seen. There's a lot of talk around what will long haul look like post COVID, and clearly we've got, you know, the world and this industry needs to address climate change. But ultimately, I believe the fundamentals will remain broadly unchanged, and you know, I think it will more likely have an impact on the aircraft types been flown, as opposed to it resulting in kind of a long-term reduction in actual air travel. Now, if you look at the graph on the left-hand side, this shows the average age of fleets by region, and that's the red line on the graph. And you see, particularly in North America and Africa, the average age is very high. So part of the solution to address climate change will be young, more fuel efficient, lower emitting aircraft. And so you are going to see significant refleeting in the coming years. And then on the right-hand side, it's an estimate of where the deliveries, what regions the deliveries will go to over the next 20 years. And really what you're seeing there is growth in Asia and refleeting in Europe and North America. So I suppose I would conclude from there that this long-term supply and demand, if you have the right asset, long-term supply and demand will come back into a better equilibrium, although, you know, it may take, you know, a year or two for that to happen. So what are we seeing in terms of activity over the last 12 months that might give us an indication of the longer term fundamentals? So clearly on the left hand side, you see the narrow body and wide body aircraft, the percentage in service at any point in time. And you see in March, clearly there was a significant reduction on all counts. But what you do see is that narrow body aircraft did return to service earlier. And clearly that's a function of the fact that the recovery, to the extent we saw green shoots, was being led by regional and domestic markets. And the graphs on the right-hand side show the rate at which different aircraft types have been returned to service, both on the narrow body and the wide body side. And this shows that new technology aircraft have been returned earlier, ultimately given, I suppose, their more efficient operating statistics. And again, this would all point to new technology narrow body likely to be more resilient as we come through this this crisis and into the recovery. And this, I think this is the last on this section, but just one last on the one last slide on kind of looking at the resilience of aircraft asset types. And this shows how the current market values of different aircraft types have performed over the last 6 years. And again, the graph on the right-hand side shows that current market values of narrow-body aircraft and new technology wide-body have been more resilient. And these aircraft tend to be the most in demand from airlines, and accordingly, they're easier to finance and ultimately to own. And we define these aircraft types as liquid. And due to their nature, liquid aircraft types have better value retention through downturns, and their values tend to recover quickly through the recovery. And increasingly, lessors tend to be focused on owning these asset types. And you can see this on the left-hand side with a higher percentage of these liquid types owned by leasing companies. And from our own perspective, 54% of our net book value of our portfolio, should I say, is comprised of new technology assets. And we're, as I said, 81% narrow body. And we made a conscious decision over 10 years ago not to invest in A330s and Boeing 777 aircraft. And clearly in the current market, that strategy has been proven out. So that's the most of the, that's kind of the first section in terms of looking at the impact of COVID on lessors, kind of the business, the asset side, and then moving to I suppose the liability side of the balance sheet and lessors' access to funding both before and since the pandemic. And in the early days of my career in this industry, Ed Hansom, he's an industry veteran, I'm sure many of you know, he explained to me, he said, in this industry, the person with the lowest cost of capital wins. And never has it been so true as in recent years, when we've really seen that increasing level of commoditization of the leasing product. And it's really meant that the economics of the business has become more spread-like. And as I mentioned earlier, I think the pandemic may disrupt that dynamic somewhat, but the broad concept long-term, I think, will still hold true. So to set some context, I've looked at the ownership structures of the top 20 lessors by fleet size, and just to kind of give an indicator of how lessors may or are funding themselves. And I've highlighted a couple of the leasing companies in each section or each category. And what's interesting is that 47% of the top 20 lessors are owned by a financial institution or an entity that can provide financial institution-like support. And so this usually means a lessor is not dependent on wholesale funding markets. And clearly this is a significant risk mitigant because, if you look back at the start of this crisis, and it was no different back in 2008, all wholesale funding markets effectively closed for a period of time. But clearly as well, it's a competitive advantage, giving you that firepower to capitalize on market opportunities in the early stages, of a market dislocation. And again, in the early months of the crisis, the majority of lessors that were active in the sale-leaseback market were FI owned. Now, clearly, some of those FI owned lessors like ourselves also have an investment grade credit rating, and this adds to your funding capability. Being investment grade clearly gives you access to the corporate bond market, but it also makes your credit a lot more appealing to a broader universe of investors and lenders. And just to explain, when I say investment grade, I mean a credit rating of at least triple B minus or equivalent. And if you look at the chart and the number of lessors, the other lessors who have an investment grade credit rating, that's another 40% of the top 20. And these lessors, primarily fund themselves through the investment grade corporate bond market. And this is the deepest pool of US dollar liquidity globally. Last year, it absorbed $1.8 trillion of new supply in the broader market. And you know, this was really critical in terms of the leasing industry's ability to access funding in size in recent months. So I would say coming into this, you know, the majority of lessors had relatively good access to funding. And this is critical because, again, just to give some context on the size of lessors' funding needs and how it has increased. 10 years ago, new delivery volumes were about $60 billion, and lessor market share was about 37%. But in 2018, new aircraft deliveries was over $120 billion, and lessors were financing about 50% of those deliveries. So it gives you a sense of the increasing funding requirements of the sector, even before you begin to consider refinancing needs. So then I just going to look at briefly the lessors' debt structures and how they have evolved over the last 10 years, and why that has meant that the challenges faced by lessors during kind of going into the global financial crisis is quite different to perhaps what we faced back last March. So here we've looked at 5 of the larger leasing companies where we have information available, and looked at changes in their debt stack over since 2009. So a couple of points to note. While it's not shown here, debt stacks were a lot smaller. Okay, but the interesting point is they were much more secured, and you can see that with the blue and the grey shading on the bar chart. Lessors that were independently funded were heavily reliant on secured bank debt and the ABS markets. And while those markets still continue to be important for certain lessors, a high level of secured debt may impact your credit ratings. And it can be, sorry, I'm just getting some feedback. It can be operationally just inflexible in terms of trading assets. Now, 10 years ago, that was less important when, with the exception of a small number of leasing companies like ourselves, the level of trading was actually relatively low. But really, with the increased size of the sector, we really needed to unlock that asset liquidity. And we're going to see, in some of the next slides, the increased level of trading that has been happening. And so clearly, having access to unsecured funding is operationally much more efficient to facilitate that. And now, again, not shown here, but where lessors had credit ratings, I would say they were very much at the lower end of investment grade, or perhaps even sub-investment grade. Now, if you move on 10 years, a lot has changed. So first of all, debt stacks of the combined 5 leasing companies here, based on the data that I've shown here, was just under $69 billion. And so, to the extent that lessors were accessing third-party funding markets, all of these leasing companies have secured strong investment-grade credit ratings, ranging from BBB- to A-. And the ratings that they have achieved really reflects the leasing companies reaching a critical size, improving asset quality and age, lower leverage levels, and then also a higher level of unsecured debt in the capital structure. And this securing these strong credit ratings has facilitated access to the unsecured markets. And so you see that with the green on the right hand side of each lessor. So again, another way to explain, I suppose, the financial strength of leasing companies coming into this crisis, and how it was quite different than, say, 10, 12 years ago. So then, just looking back to where leasing companies were funding themselves coming into 2020, and really there was strong access to a diversified range of funding markets. Lessors who were FI owned were probably receiving some form of shareholder support to underpin their liquidity base. In terms of the capital markets, the investment grade corporate bond market was the primary source for the investment grade lessors. And in the previous 5 years, we had seen about $43 billion of issuance. And that was really important, and it's really important, I think, when we look at how the market has performed since last March. But that investor depth, has been really building that investor depth has been really important to the resilience of this market. But as that investor base grew, and really, I suppose, the broader liquidity in the bond market, we saw very significant spread compression. And really, coming into the beginning of last year, the difference in secondary bond spreads between a BBB minus rated bond and an A minus rated bond was only about 40 or 50 basis points. So it was a very efficient market, I would say. Also in the capital markets, you had the US private placement market, and this was very active, although I would say volumes into our sector was relatively small. The reason it was important is it provided diversification for leasing companies, and it also provided a source of unsecured funding for non-investment grade lessors who perhaps were on a path to investment grade. The bank markets were buoyant. We'd seen very significant growth in the unsecured debt capacity in recent years, and that was primarily coming from Asia. Ultimately, I suppose it reflected, again, just the broader market liquidity, but also the fact that lessors' balance sheets were strengthening. I think an important point here was really the access that this market gave to leasing companies, the access it gave to standby revolving credit capacity. And that really contributed to the high levels of liquidity that lessors had when this crisis hit. Now, the secured bank market was being used and was still playing a significant part, but it was being used by some of the larger leasing companies as a diversification, but primarily, I would say, probably being used by non-investment grade leasing companies or fund structures. The ECA market was very limited, and that was really a function of the capacity that was available in other markets. And then finally, the ABS market was really buoyant. And again, another big development, I would say, of the last cycle was the growth in that sector. And it started, and I'll talk a little bit about this, but it was used both as a funding vehicle for midlife assets, but also a distribution channel for larger leasing companies who were selling the majority of the e-note or the equity in the transaction. And I think that the development and the growth in the ABS market was really interesting because the level of liquidity that it provided, together with the liquidity in other funding markets, really drove a very strong secondary aircraft trading market. And that was I think a really positive development of the last cycle. And just to kind of maybe look at that a little bit more, if you look at the chart on the left-hand side, it shows just the growth in aircraft trading coming through the cycle, both on a bilateral trading and also then sales into the ABS market. And this facilitated lessors in recycling their capital. It allowed them to monetize some of the inherent gains in their portfolio that maybe they had depreciated, and it was a really important portfolio management tool. And if you look on the right-hand side, the pie chart at the top shows that about 20% of lessors' cash flow was coming from trading, coming to the end of the last cycle. And it was also a very significant contributor to the bottom line. On average, it was contributing about 16% of PBT over the last 3 years. Now, I would say that the level of contribution did vary, across leasing companies. And for some, I would say, again, like ourselves, for us, it was it was a contributor, but it was a very important portfolio management tool, I would say, in terms of the fact, keeping the aircraft young and managing concentrations. But you know, it was a really is you know, having an effective distribution channel as the market allows the market to grow, and it really is kind of important to the long-term success, I would say, of the industry. And clearly, as I said, the liquidity that we had seen in the market facilitated that. So enough context, perhaps maybe we just turn to, I'm just going to spend a moment just looking at the different markets and kind of how they've evolved. You know, the easy one is shareholder funding, because clearly when the music stopped, you know, a lot of markets, most markets closed. So having access to that shareholder funding, you know, was really important for those that had it, and it would have given a lot of comfort to other third-party financiers who were lenders to that leasing company, and also the rating agencies, that there was a kind of an effective backstop there. You know, I also think it's a very important risk mitigant from the perspective of refinancing, because again, if you take 50% of our funding comes from our shareholder, but that effectively means that you know, when it matures, it's effectively available for redrawing because it's revolving in nature. So you know, there's a significant risk mitigant to having shareholder funding in your debt structure, in addition to the fact that you have that firepower when you need it. Then looking at the corporate bond markets, so I've talked a lot about how they have grown in recent years, and today I think there's just over $70 billion in bonds outstanding today. Clearly, it's the primary way that the investment grade leasing companies access their funding, and really you know, it's the depth and efficiency of that market that's so important. And you can see in the bar charts here how the debt stacks of these different leasing companies have changed over even the last 7 years, and the level of unsecured issuance in their debt stack has increased. Now clearly, achieving and maintaining a solid investment grade rating is critical to maintaining access to that market. So let's look at how that has evolved. So this slide shows the lessors who have an investment grade, who access the US corporate bond markets. And what's interesting is, if you look at kind of over the last 6 years, you've seen a migration upwards, you know, to improved ratings for most of these leasing companies, and that migration, together with the broader liquidity, has resulted in that kind of very tight pricing that we saw just kind of you know, up to last January. Now you know, the reality is, the competitive leasing environment that we found ourselves in was somewhat a function of the fact that many leasing companies had access to this competitive funding, but really having access to it was critical, or similar funding was critical to competing in it. And you know, I know a number of these, most I think of the rating agencies have put most of these names on negative outlook, and that's really due to a lack of visibility on the airline recovery side, as opposed to you know, lessors' financials. But to date, none have been downgraded. So then looking at how spreads, how did the market perform since March? Well, you see here clearly when the pandemic did hit last March, you saw significant gapping out in spreads, and that was particularly so for the non-FI owned lessors who were maybe rated in the BBB ratings category. However, you know, lessors began to access this market as early as June, and really, while it was at elevated spreads, from there, because it provided such comfort, you know, to investors and to the rating agencies, that lessors could actually access liquidity and meet their commitments, that really, you know, that began a cycle of issuance from most of the leasing companies. And as the year evolved, we saw continuing tightening of spreads to where they are today, which is really probably 20 to 50 basis points wide, within 20 to 50 basis points of where they were 12 months ago. Although I would say we do see more differentiation between the spreads on different rated bonds. Now, at the same time, you see the red line. You see the red line, which shows how US the 5-year Treasury performed over that period. And as many of you will know, that Treasuries have come off about 100 basis points over the last 12 months. And so what that means is that leasing companies now that are issuing at historical lows in overall coupon terms. And that's going to, we've seen some signs of it already, but it is going to drive competition in the sale-leaseback market. Now, the outlook for this market in the short term to medium term, it does seem very positive. In the last 4 or 5 weeks, we've seen about 7 billion of new lessor issuance, and really with really strong execution. The market technicals are very strong. If you look at the very strong level of issuance in 2020, market supply is not expected to be as high this year, and so a lower level of supply combined with just the huge liquidity in the market ultimately is going to be good for issuers. Now, the counter to that is if the recovery is a little bit more prolonged in our industry, you could see sentiment towards the sector change and wax and wane. It may move for periods of time, and that will have an impact on spreads. But I think a lot of leasing companies have gotten out early this year, with the positive window that was available. So then looking at the commercial bank market, so prior to last March, you probably had 50-60 banks who were active in this market, and they were active both on the secured and the unsecured side. And in recent years, because of the growth in the level of unsecured, you saw lessors were very much focused on tapping that side of the market. And that was because of the positive impact on ratings, the ease of trading that it facilitated, and also the access it provided to kind of RCF capacity. And again, that capacity was coming primarily from Asia. Pricing in the market was competitive, and while you find with bank pricing it tends to be stickier than bond market pricing, I would say the market was probably pricing drawn secured debt at kind of plus or minus the bond market, so broadly in line. And what was interesting was actually the secured bank debt lenders were finding it increasingly hard to compete, and many of the banks were beginning to look at how they could actually provide some unsecured capacity to the market. Now, tenors in the unsecured market were kind of in the 3 to 5 year range, depending on the credit quality of the lessor. But many, well, I wouldn't say many, but some banks were definitely beginning to look out to kind of 7 years for stronger credits. Now, when the crisis hit last March, the bank market did retrench. Clearly existing lenders were dealing perhaps with forbearance requests from their own airline customers. And given that the bank market tends to be, to a certain degree, a take and hold market, I would say that the appetite for new business largely disappeared. And today, I think there's probably 6, maybe 10 banks who are truly active in the sector. You found that a lot of the non-traditional aviation banks, they've redirected their capacity back to their domestic markets. And really where capacity is available, it's very much focused on tier 1 airlines and leasing companies. The unsecured bank market is relatively limited in capacity. There's pockets of liquidity, I would say. And then there is capacity, although smaller, on the secured bank side, but terms are more conservative and structures are more conservative. But I think the important thing to remember is, there's still a lot of liquidity in the broader bank market. It isn't like 2008, and at the moment that capacity is being directed towards sectors such as infrastructure and renewables. But really, I think you could see liquidity return for aviation risk as the recovery becomes more apparent. Although, that may be tempered by perhaps if banks need to take provisions against existing exposures, and they clearly need to, manage regulatory, exposures from a regulatory perspective as well. But in the meantime, as I said, bank lending is very much relationship based and focused on tier 1 credits. So then looking at the export credit, the export finance market, so traditionally this market is active more in a downturn when other funding alternatives are not available. And really its purpose is to make sure that aircraft produced in a home country gets financed, and it's really designed more to be a lender of last resort. Now, if you go back 10 years, this form of funding was more widely used by lessors when their funding base was less diversified, and their access to third-party funding ultimately was more limited. But it is a really important backstop financing and a really important risk mitigant, I would say, in this industry. But the structured nature of the product, and indeed at times its relative pricing, means it tends not to be used in stronger markets. And you can see that in the graph here, where clearly, the percentage of new deliveries financed by this form of financing has reduced considerably in recent years. The other point I think that's maybe worth noting in relation to ECA financing and the Airbus product is that the due diligence process that you now need, you go through as part of accessing that financing means that, practically speaking, it's more likely to be used by lessors for their order books as opposed to kind of sale-leaseback transactions. So finally, onto the ABS market. As I mentioned a couple of times in the presentation, the ABS market was an important driver of market liquidity and asset liquidity in the last cycle. And I think total issuance over the cycle was over $40 billion. And the drivers of the growth were twofold. So I would say the cycle began, it was primarily providing funding in size for midlife assets, and it was a much more efficient way to fund those assets than, say, the bank market. But like as the investor base grew, so did their knowledge, and that, together with some kind of structural innovations by the banks, meant that as the cycle proceeded, investors migrated down the capital stack, and it facilitated then the sale of e-notes or the equity in the deal, and so it became a distribution or a trading tool for leasing companies. And you see this growth. If I go to the next slide, you see this growth by the dark blue bars on the chart show the ABS that were issued with an e-note attaching, and so you can see how that grew as as the cycle proceeded. And if you look at the chart on the bottom, you also see the fact that spreads compressed as the cycle, spreads on the A-notes compressed as the cycle evolved and elapsed. And, that actually in itself was critical to facilitate the sale of E-notes, because, you do need a pretty efficient capital structure, and particularly on the A-notes, to make it work to issue E-notes, and so that the overall total proceeds kind of make sense from an issuer's perspective. Now, if we look at the performance of this market since March, so interestingly, at the end of the last cycle, so kind of in 2008, 2009, the ABS market was actually very small. We had an issuance in the market, but it was only really a couple of issuances. It was primarily used for funding. And when it closed, the market really closed to aviation for a couple of years. Now, we had a similar experience last March for aviation ABS transactions, and it did shut for a period of time. And you can see on this slide how aviation spreads on aviation ABS notes really gapped out, and you know we were seeing secondary pricing points on A notes of up to 16%. Now the only thing I would say about that was that trading was actually relatively thin, so those price points were perhaps forced sellers, and relatively few. So you know it did gap out for a period of time, but it has actually tightened in since then on the kind of the A's and the B's. And I think what's really interesting is how quickly it's potentially reopening for funding transactions. So, you know, many of us will have seen the Castle Lake transaction that was done last week. So they issued $600 billion of debt. And I think there was about somewhere under 30 investors. Now, you know, I'm not that close to it, but I understand that the investors were existing investors in the sector. And so while the spreads were wider and the structure was more conservative, like the reopening and to that size is really encouraging, because there's a lot of equity on the sidelines wanting you know, to put money to work and to buy assets. But to date, really, there's been limited debt available for many of these asset profiles. So the potential reopening of the ABS markets, even on the funding side, I think will start to facilitate you know, the growth in startups, and that's going to be good for everybody in terms of bringing back some, you know, asset liquidity. And it's also going to provide potential refinancing alternatives for existing fund structures, assuming that it can be replicated. And you know, you would expect that you know, the first one is always sometimes the most difficult to do. You would hope that if market conditions are maintained, that you know, future issuances will just increase in efficiency. So just to conclude, you know, I think as we look forward, you know, we clearly are living in unprecedented times. You know, and while 2020 has presented significant challenges for us, it's also presented really strong opportunities, particularly for FI-owned lessors with strong access to funding. Now, the first half of 2021, I think it is likely to be challenging, but the second half, or perhaps the second half of the second half, I think would be more promising. You know, and I think when that recovery does come, the level of pent-up demand for travel is likely to mean that it will happen quicker than people expect. And when the recovery unfolds, I think you're going to see an increased demand for leasing. You know, the recovery will be led by young, fuel-efficient, narrow-body aircraft. So lessors focused on those assets are likely to do better. As I mentioned, leasing companies coming into this this situation were well capitalized, and that's really been critical to how the sector has been able to deal with the challenges presented. And again, actions that we've taken in terms of capex and etc. over the last year, and bond issuance, and you know, raising liquidity either through shareholder or other sources, has also strengthened that position. I would say on the, you know, in terms of funding, and as we look forward, lessors who have access to shareholder or bond markets are likely to be best positioned to grow and to take advantage of market conditions. But you know, the corporate bond markets have proved to be very resilient, and it really is testament to that investor depth for aviation risk that has been built up over the last cycle. And then I suppose in terms of other funding markets, I would say the liquidity is there. It's just going to take time to return. And we always, you know, I think we should be not mindful, but, you know, we're very lucky to have the ECA and EXIM products available as an effective backstop for certain deliveries. And then clearly the reopening of the ABS market is another very positive development in terms of providing funding and size for assets to non-investment grade lessors. So I think on that note, Niels, I will hand it back to you.
Okay, thank you so much, Esna. I appreciate that. My internet is still wobbly, so I'm trying to do this over the phone.
Okay, I think I've stopped sharing, have I?
Okay. There are a lot of questions that have come in. and they are around a theme, which is that airlines have, of course, suffered greatly during this pandemic, and they have had a lot of help from governments. And also, people have been laid off and costs have been cut, and some of those costs have been picked up also by governments. But nobody seems to feel sorry for the lessors, and they also will suffer for deferrals and impairments and so on and so forth. I don't really foresee a situation where leasing executives will be laid off and their salary will be picked up by the government. So the question is, well, there are a lot of questions actually around the lessor's ability to raise funds going forward. And of course, this is super important for the airline's recovery because the lessors represent such a big share of the total funding that goes into the airline. So I think the first question that came in that is hinting at this is, what is your general feeling about lessor profitability and return on assets in 2021?
No, it's a good question. I think it's going to vary across the sector, and I suppose I don't mean to repeat myself, but I think it will depend. Firstly, in terms of the quality of the portfolio, the existing portfolio that the lessor owns, and because as we come through this, come through the recovery, I've talked a lot about it being led by narrow body, fuel efficient, and all of that. But I mean, if you own the right asset, yes, you might have. You might have some challenges in placement in the short term, but long term, that's going to even its way out. So I think first of all, it depends on the existing portfolio that you own and how in demand those aircraft are, and then it also probably depends on what new business you are able to do in 2021, or even that you have done in 2020. So clearly, if you can be active in the market at the moment, there is some, the returns are, if you look at risk-adjusted returns, they've improved considerably versus, say, last March. So that's also going to help your overall profitability. So I think on balance, it's going to probably be a mixed bag. Can you hear me, Niels? I don't know, have we lost Niels? I can't hear you, Niels.
We're trying to bring him back now. One moment,
okay.
Please.
Can you hear me now?
We can hear you, Niels, yeah.
Okay, good. Okay. So a related question is from Dermot Walsh. He is asking, do you think that we're going to see a return of the e-notes in the ABS market?
It's an interesting question. I mean, what do I think? So I suppose what I would say is that, if you're an issuer issuing e-notes, then clearly you're using it as a distribution tool. And then it's a question of you're looking at what is the total proceeds that you can get from issuing into the ABS. What's the total proceeds from the AB, maybe C, and e-notes versus if I'm to sell those assets bilaterally. And what I've found, and we've looked at it many times, is you need a really, really, really efficient capital structure in the ABS market. And primarily driven by the cost of the A notes, to make it compelling that the price that you can get from that market is a price that you'd be willing to trade your assets at. So I think the reality is, I think we're some way away from that, probably a long way away from that yet. And I think if it does come back, I think if you look at kind of e-notes today, they're heavily discounted, that exist today are heavily discounted. So I think that, you know, where structures that are selling e-notes, I think e-note holders are probably going to be very focused on, you know, credit quality, you know, asset type and lease terms. So it's going to be more difficult. I think it's going to take time. But what I would say is that, you know, a lot of equity that is on the sideline, new equity that wants to come into the sector, is likely to use the market now to fund itself.
Yeah. Quite an interesting question here, and that is, why is it that the bank market has retrenched while other sources of funding have been relatively resilient?
Yeah, I mean, you know, in some ways, I probably, you know, it's not dissimilar to previous crises, but I suppose if I was to be honest, I was probably quite surprised at the extent of it. But you know, again, if you look at the corporate bond market, I mean, it is just so deep. And the bank market's just not that big in relative terms. So that's the first point. I mean, if you look at even our bond complex, we have over 300 investors. So it's just much bigger. The second thing is it's more liquid. And so what that means is, like, if you look at today, lessor bonds, even though they're pricing very efficiently, they're still probably maybe 20, 30 basis points wider than maybe other transportation bonds. So your investors will trade that arbitrage, okay? And they can do that because you have that liquidity, and you don't necessarily have the same liquidity in the bank market. And then I think another point is that you know, a lot of the traditional take and hold participants in the bank market have retrenched, as I've talked about. And what that means then is that really there's no underwriting going on. Everything's on a take and hold basis. So the larger banks that might be active, they're not taking underwriting positions. So clearly that has really contracted the market. And then, you know, maybe, you know, something I'm not, you know, an expert to opine on, but I suspect from a regulatory perspective, banks also have, you know, issues around kind of exposures to different sectors that they need to manage, and that's probably playing a part as well, you know.
Kieran Ryan is asking, how much trading activity are you seeing now? I mean, you mentioned that was an important source of funds for lessors. Has that abated a lot during the crisis so far?
Yeah, I mean, what I can say is, yeah, there's been very little trading. Now there has been some, but very little trading in the last 12 months. And I think what's been interesting is leasing companies didn't, even though I talked a lot about the cash flow that it did deliver, you know, when the music stopped, leasing companies didn't need to trade to generate that cash flow. They had sufficient liquidity. And I suppose over the last 12 months, you have seen China has probably been a market that's been continued to be active through last year, but primarily for leases on, you know, longer leases, probably on to Chinese airlines. So there was a market there if you wanted to sell some of that inventory. And we sold one aircraft into that market, but I would say very limited. I would say that you are beginning to see leasing companies test the market now. You're seeing some small portfolios come to market. And I think that, again, to go back to kind of the Castlelake transaction, I think that you did have a lot of maybe equity which were looking at acquisitions, but ultimately were perhaps pricing it using kind of a cost of equity or perhaps, you know, expensive bridge financing. And I think that now with the Castlelake transaction, and if there's further transactions that becomes more efficient, I think you may see buyers, those type of buyers being able to be a little bit more competitive in their cost of capital assumptions, which will ultimately allow better pricing. And, you know, you might see the bid ask between the buyer and seller narrow. So you know, we've seen a little bit of that ourselves. So we are seeing, in terms of you know, our trading partners, we are seeing some improvement in pricing.
Here's a fun question that came in. How did the OEMs react when lessors are deferring new deliveries while they are very active in the sale and leaseback market or purchase leaseback market?
You know, at the end of the day, you know, we have where we have deferred deliveries. You know, we have a contract, and you know, we speak. You know, we sit down, we speak with the OEMs, and we come to an agreement that works, that's mutually you know, beneficial, or mutually works for both parties. So I don't think it's a case of we forced deferrals on the OEMs. I mean, ultimately we got to a position where, you know, where we and they were comfortable. But you know, it's pretty. It's been a real positive, I would say, from the leasing company's perspective, their ability to do that, because, you know, that's why many leasing companies will have kind of a twin track acquisition strategy, and kind of pivot from one to the other depending on where the opportunities are. So and you know, it probably has been helped. Clearly, you know, the MAX I think is a separate issue. You know, the delays there kind of probably, you know, changed changed kind of the dynamic. But even, I suppose, Airbus, I mean, they've reduced they've cut their deliveries as well. So yeah, ultimately I think we got to a place where, you know, all were comfortable.
Yeah, I mean, I think there's an economic reality behind this, in the sense that the lessors' funds maybe should be used to shore up the liquidity of the airlines rather than adding more capacity to the system, right?
Yeah. Look, you know, I mean, both manufacturers have cut capacity. You know, Airbus is down to 40 a month, and clearly the MAX is, I think, only coming out at about 5 a month at the moment. So that obviously helps the dynamic, and as I said, it's in nobody's interest really to flood the market.
Yeah, of course, that's a part of the solution. There is a student at the UCD Aviation Finance Program, whose name is Rhino Norona. He's asking, what are your thoughts on the ESG? Do institutional investors place conditions that are ESG related in our space?
In relation to ESG?
Yeah.
Yeah, not necessarily today. But that said, I mean, I think that I think the industry as a whole, and I think the leasing community, is very conscious that it is something we need to address. And from our own perspective, you know, I suppose if you look at the bigger picture, you know, there isn't really a viable alternative to fossil fuels at the moment in terms of aviation. So clearly the short-term answer is probably about the types of, you know, fuel efficiency and the types of aircraft that you fly. But longer term, we do need to come up with a better solution. But like, you know, even from ourselves, I mean, we're very focused on it, and we spend, you know, we have a project team who's responsible for this, and you know, today we're operationally a carbon neutral business, and so it's something we're taking seriously. And then we're also looking at other alternatives of how we could work with airlines to support them to become more carbon neutral. So I think it's not something that institutional bond holders have raised today, or at least it's not restricting them, I think, coming into the sector, but it is something I think everybody is very conscious we do need to address.
Yeah, but on the subject of eco-friendliness, do you think that there is going to be conditions attached to state aid and so on and so forth in relation to, you know, penalizing older aircrafts that are more fuel consuming?
Yeah, I mean, you know, we've already seen some conditionality to some of the government support, you know, around, around environmental points. And I think if there's, you know, if there is further government aid, we could see more, you know, more conditions to that aid around the environment. But yeah, I mean, even aside from the government restrictions, I mean, you know, you see, you know, there is, I think in Austria, I think they have minimum fares now, and you know, so I think it's I think governmentally, it's kind of top of most governments' priority list now. And so, you know, I think we all need to prepare for how we deal with that.
Yeah. You showed a chart early on with the fragmentation of the lessor market. Now, do you think that post-COVID we're going to see renewed focus on consolidation, where stronger lessors buy out the smaller ones?
Yeah, look, I mean, you know, the reality is, I think through the cycle, we've seen a lot of M&A activity in this sector, and there's definitely, you know, again, going to the whole commoditization of the potential long-term commoditization of the product, the need to kind of, you know, to increase in size and economies of scale and all of that. But I think in terms of near-term consolidation, I think there will be further consolidation. But it'll probably take some time. And I think there's two probably points here. The first one is just access to financing. Clearly, you know, FI lessors have the potential to look at acquisitions, but even in terms of refinancing, you know, the market, although the broader M&A market's very hot, I think, you know, that access to kind of financing and size to fund acquisitions in the sector is probably not quite there yet. And then I think the second point, again, not to keep going back to it, but, you know, while the sale leaseback market continues to offer attractive opportunities, that's going to be kind of, you know, that's the opportunity, an acquisition, that's the opportunity cost of doing an acquisition perhaps. And so, you know, you're going to have to, it's again, the kind of bid offer between, you know, sellers' expectations and what a buyer might be willing to pay. There's probably still a bit of a gap there as well. So I think it will happen, but I think it's a little bit off. Niels, can you hear me? I think we've lost Niels again, have we, Zach?
I think we're having a little trouble with Niels' connection here. It just dropped off. So I think you can go ahead and put a final word for our audience, and we'll wrap it up.
Okay, thanks, Zach. Well, it was a pleasure. Hopefully, it was a pleasure to come and speak with you today, and hopefully some of you would have learned something and taken something away from it. But yeah, delighted to share my views, and just wish you all a good morning, good afternoon, or good evening, wherever you are. Thank you.